earnings are going to go down. And then as a result of that occurring, multiples are going to go down. So if your 20 PE multiple becomes a 10 PE multiple, you just lost 50% of your value. And if your earnings were $10 a share and maybe it goes down to 6 or 7 because you're in a recession.
Hey guys, welcome back to Everyday Finance. In this video, Larry Lepard discuss about Bitcoin, according to Larry Lepard. When we witness another 20 or 30 dip in the S&P and Larry Lepard in the next year, Larry believed that another 30 is a no-brainer. Absolutely no-brainer. Extremely likely believe there's a chance the S&P will drop by 70 or 80% before this whole event is complete. One factor that often slips people's minds while recalling stock pricing is a few points. First, you are aware that there are several incomes, and you also understand the various earnings, correct? Presently stands at the upper end of the range, approximately 20 on the S&P. As you are aware, the lower end of the range is 7 and 14 is the median. When you examine historical inflation and inflationary eras, what you observe is that rising labor costs drive margins to contract, and lots of things Larry Lepard discussed. So please watch the video to end, and share this video and subscribe our channel Everyday Finance. Thanks.
Another 30% is a no-brainer. Okay. Absolutely no-brainer. Highly likely in the next year we see another 20 or 30% dip in the S&P. And I think there's a possibility before this whole thing is over, the S&P is down 70 or 80%. One of the things that people forget, remember, stock prices are a couple things. One, there are multiple of earnings. And so, the multiple of earnings right now is around 20 on the S&P. And that's at the higher end of the range. The low end of the range is 7 and the median is 14. If you look at prior inflationary, and you look at prior inflationary periods, and what you see is that margins get squeezed because labor costs go up. And so you got kind of a twofer here. If you get, and also there's an alternative. People can buy treasury bills and get 5% now. So what could happen here, I think, is that margins are going to squeeze earnings, so earnings are going to go down. And then as a result of that occurring, multiples are going to go down. So if your 20 PE multiple becomes a 10 PE multiple, you just lost 50% of your value. And if your earnings were $10 a share and maybe it goes down to 6 or 7 because you're in a recession, then you multiply that times 10 and now you're at 60. So you've lost 60 or 70% in your stock. So I think my personal view is that the U.S. stock market is a minefield. I mean, I think the U.S. bond market's an even worse minefield, but I think both of them, and it's not unusual for this to be the case because what you got going on is recency bias. I mean, since 2008, every investor in this country and in the world has really been trained to buy the dip. It's always worked. It's just always worked. And I think I talk to a lot of people. I know a lot of people. I'm 65. I know a lot of people my age who say, well, I'm down 20%, but it's always come back in the past. And they say you got to have a long-term view, blah, blah, blah. I'm only down 20%. I'm not panicking. I'm not selling. And I'm kind of like, well, okay, I get it. But, what happens when you go down another 20%? How's that going to feel? Do you know what I mean? And because it feels to me like that's what's coming. So the Great Depression. I'm telling you, get your bullets and get your food. And no, look, these things take time to play out. So let's talk about what, the end of the dollar, because that's a little different than economic activity. I think that what's going to happen is economic activity is going to slow down. And the natural thought would be, okay, economic activity is going to slow down, but inflation will too. And that's where I think the disconnect is going to come. This is going to start to look like the 70s. The economy is going to be slowing down, but inflation is going to keep right on going. And that's going to be a real squeeze because some people are going to lose their jobs. All companies are going to be making less money and everything's going to cost more. And so, and it's the inflation piece that informs my view that the dollar is going to fail. Let me talk about that and explain that. I think as inflation continues and as the economy slows down and as the debt thing continues to play itself out, I say we're in kind of a debt doom loop, and that term has been used by others, but it really is an accurate term. And it is, the case is that the government can't meet its expenses, and so they have to print money to cover the deficit, and that printing money creates more inflation, and that additional inflation causes the bond market to sell off more, which then causes interest rates to go up, which then causes the government to lose more money, because the deficit's bigger. And so, it's the problem gets bigger and bigger until such time the government's forced into either printing money to cover the deficit and or printing money to do yield curve control, which I should explain for your audience. It's basically they print money in order to buy their own bonds. And this is really kind of third world banana republic stuff. And we've seen this. This is not...
According to Larry Lepard, given that's what's been done in the past, Larry would assume that answer would be most likely yes, the past. Britain, for example, others have done it. But Larry Lepard don't think they're prepared to utilize Bitcoin, which is another potential. As well as another option is to adopt a commodities standard in which they would link the currency to a collection of commodities, like as oil and other energy sources are known as inputs. Yet, what these require is the currency itself. The currency supply must be linked to something that isn't solely arbitrary altered, so you know you can't print it correctly. That's actually the problem. These individuals are yoing the currency, which is the reason we're in this problem. Let's back to the Larry Lepard interview.
This is not unusual. I mean, Venezuela did this, Zimbabwe did this, Brazil's done it, Argentina's done it, Weimar Germany's done it. There have been many, many cases of hyperinflation. China did it, after Chiang Kai-shek. I mean, what happens is when a government gets in a position that they cannot meet their costs unless they print money, that puts them in a very difficult spot. And as soon as everyone realizes that, and that's the big thing, the psychology we talked about last time, it's when is the recognition that they can't stop printing money? Because when it becomes common knowledge that they can't stop printing money, that's when what we call Gresham's law kicks in, which is to say everyone goes, oh, I get it. You're giving me these dollars, but I know in a year they'll buy less. I need to spend them right now. Or I need to put them into something you can't print. And the two go hand in hand. And so you get people hoarding things and buying things ahead, and that makes the inflation worse. And or you get people, buying gold or Bitcoin or land or just anything that the government can't print because it's, their printing is something that will not stop. So that's how I see. And I think that's coming, right? I think that's within the next year or two, conditions will be bad enough. People will be screaming enough that they will print. They'll have to print. That's right. I mean, I say hyperinflation. I mean, currency failure, basically currency failure. Now, look, I believe it's going to happen, and that's just based on what I see as the political situation that we've got. It does not have to happen, and there are other ways out, okay? We could just have extremely high inflation for a bunch of years. Not hyper, but just high, kind of Argentina style, 15, 20%. And if we did that and we somehow were able to control the costs and stop the debt from growing rapidly, eventually GDP would be big enough that we would be able to live with the kind of level of debt that we have. But my sense is that politically, we're not going to be able to stop that growth in debt. I mean, people sometimes say to me, what could go wrong if I invest in your fund, Larry? And I say, well, what could easily go wrong is if the government decides to balance the budget, cut defense, cut, Social Security, cut Medicare, and, get incredibly responsible, then my fund's not going to do very well. And of course, people laugh at me because what are the odds of those things happening? I mean, they're not zero. And maybe government will ultimately maybe people will get in there who are smart enough to realize that, and they will do those things and hyperinflation will be averted. I think another possibility or another way to avert hyperinflation, and you and I talked about this pre-show, is that they could, in theory, do a one-time restructuring. I mean, this is what Roosevelt did in 1933. He grabbed the gold and then he revalued the dollar against gold. And, that could happen today. I mean, and different analysts have different numbers. I've noticed that, if you look at the amount of paper or the amount of money supply outstanding and the number of ounces of gold that the U.S. owns, assuming we really own it, which is a whole different discussion. But let's say for the sake of argument, we do own it. To make the two balance, you'd have to be at $80,000 an ounce. That's a long way from the 2,000 we just crossed today. Luke Groman thinks you could do it for $20,000 an ounce. Again, that's a long way from the 2,000 we're at today. I mean, the government needs to find a way to reduce its debts relative to the total size of the economy. Full stop. If they don't do that and they continue down the road we're on, if you look at history and you look at all the other countries that have done what we're doing historically, it's led to hyperinflation.
Larry Lepard predict that economic activity will decline and that the general public's perception will be while economic activity will slow down, inflation will also rise. And that is why Larry believed this is not going to happen, but rather will begin to appear as the economy will slow down in the 1970s. But inflation will continue to rise, and that will be extremely tight because everything will cost more. Some individuals will lose their jobs and businesses will want this money. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.